Hi there, my name is Randy Helm. Today's topic will be on the statement of cash flows. By now you're probably already familiar with the income statement and the balance sheet. If you're not, feel free to check out one of my videos on those topics. If you're interested in your cash, those reports do have some shortfalls. The income statement, while it does tell you how well you're doing towards your goal of net income, it doesn't really say anything directly about cash. There are several transactions that could impact net income, but not touch cash. And the reverse is true. There are different transactions that could impact cash, but not net income. On the balance sheet, it will tell you what your cash balance is, but it doesn't tell you how it got there. Keep in mind that this report will be coming directly from your accounting system or from your accountant. It can be challenging to prepare, so we're not going to cover those details here today. If you don't currently receive this as part of your normal financial package, I would suggest you call your accountant and ask that it be included on a regular basis. Now, if you're ready, let's begin. As I mentioned, we're covering the statement of cash flows. And there's three main sections: the operating activities, the investment activities, and the financing activities. We'll cover each of those. And to throw a wrinkle into it, there's two main methods of preparing the statement of cash flows. There's the direct method and the indirect method. And we'll cover both of those. So buckle up and let's get going. First, we're going to go through the direct method. Now, the first section is operating activities. As the name implies, this shows the cash implications for the base of your operations: selling goods and services, buying your supplies, paying your employees, paying interest on your debt, and paying taxes. That is what shows up in the operating activities section. And so these things, whether they're positive or negative, they will show in this section. The second section is on investing activities. If you buy stocks and bonds or acquire another company, you buy fixed assets, the cash used for these activities will show in this section. Also, if you acquire any intangible assets, it would show in here. So what are intangible assets, you might wonder? Well, that's a long story, but like MC Hammer says, you can't touch this. Hence the name, intangible assets. We'll have a separate video on that. Just for now, know that it's not very common. So also, not only when you buy these items, when you sell these items, the proceeds from the sales will show up in this section. You sell stocks, bonds, you sell a company, you sell fixed assets, or even the intangible assets. The proceeds from the sales of these items will be shown in this section. And the income on any investments that you might make would also be showing up in this section. Okay, this third section is the cash flows from financing activities. That is where you would show money that you received from shareholders, such as from issuing stocks or doing cash calls, or paying dividends out to the shareholders. It's also the spot where you would show receiving money from a bank, such as obtaining a loan, a mortgage loan, or what have you. And as you make payments on the loan, the principal portion of those payments is shown here. The interest expense is not, however. That is actually shown up in the operating section. So the money between the shareholders and the company, and between the bank and the company. Principal only, not the interest expense on the debt. Hope that makes sense. If you do have any questions, please feel free to leave those in the comments section down below. Well, we've been talking about this report. Let's actually look at one. Here's the first section that we talked about. Cash flows from operating activities. It has a total associated with it. Here's the second section that we talked about, the investing activities. And a subtotal is with that. And the third section is the financing activities. Of course, there is a subtotal with that. When you add these together, you get the net increase of cash for the period. You can see in 2020 it was about $102,000 increase, and in 2019 it was about $133,000 increase. The beginning balance of cash is listed, and then when you put that with the net increase, you get the ending balance of cash for the period. So that is the direct method. Are we done yet? No, we haven't even looked at the indirect method. Let's go to that next. Well, if you remember how the direct method went, we had the operating activities, we had the investing activities, then we had the financing activities. For the indirect method, we have those same groups. In fact, for the investing activities and the financing activities, there is no difference. So we will only need to discuss the different way of addressing the operating activities. In the indirect method, we start with the net income or net loss. Then we make adjustments for items that impact the net income that don't involve cash. A good example of that is depreciation. That's a non-cash event, but it does tend to lower income, so we add it back in. Then we need to move items that belong in another section, such as the investment income. That belongs down in the investing activities section. And we make adjustments for changes in working capital. This part tends to trip people up sometimes, so we'll talk a little bit about that. So as I stated, we start with the profit or loss, which is this line right here. And as you can see from the description that it's before taxes, so we do show taxes paid here. Next, we want to take into account items that affect net income but do not affect cash. Depreciation, I mentioned that in our example just a couple seconds ago. That is that line. This investment income, that is reclassing the amount down to the investing activities section. So that's what is happening here. It actually is moving it down below. Then we have a profit or loss on the sale of fixed assets. This line right here. I mentioned before that the proceeds from the sale of fixed assets goes into the investing activities. But if there is a gain or loss, that actually shows up here and not in the investing activities. Seems strange, but those are the rules. Now I want to talk about working capital changes. That's this section right here, and it trips up a lot of people. Let me just paint a picture for you. If you recorded sales and gross profits in your books based on the accrual method, and you gave the customer 30 days to pay, you'd have net income on your books, but you wouldn't have seen the cash. The receivables would have increased and not cash. And in those situations, when the accounts receivable increases, that means you're not getting the cash. So we subtract out increases in the accounts receivable. When they do pay, let's say they paid in the next period, then you're getting cash in that next period for which there was no net income recorded in that period. It was recorded in the previous period. In those instances, we would add back in the decrease in the accounts receivable. And the accounts payable, which is just a couple lines down, that behaves in a similar way, but with the opposite signs. So imagine you bought product from somebody, supplies, and sold those to your customers. When you bought these supplies, you didn't pay your supplier for, let's say, 45 days. Then it would be showing as an expense, but you didn't pay for it yet, so the cash hasn't gone out the door. So when there's an increase in accounts payables, that means you didn't pay for the stuff. And so we add that back in. And then in the following period, when you do pay it, then it comes back out. It tends to wash out from one year to the next, as long as everything's working hunky-dory. But if you're still a little bit confused on the working capital part, just know that you're not alone. That takes a little while, and the first several times you see this report, you have to really go slow and think it through. But after a while, it does become second nature. Well, here are the two operating activities sections side by side, the direct method and the indirect method. You can definitely see they're very different. They get to the same number, the 200,000. The direct method is real simple: cash receipts, cash going out the door, bada boom, bada bing, $200,000. The indirect method starts out with your net income, and then you have depreciation adjustments, a reclass, and then you have a lot of working capital changes that you go through, and then you get to your $200,000. Both reports have their pluses and minuses, has their pros and cons. So I would encourage you to actually read both of these for your company for a while until you get a good understanding of which serves you better. Well, I hope this has been helpful for you. If you have any questions, feel free to leave them in the comment section down below. Thank you. This has been Managing Your Business by the Numbers. My name is Randy Helm. Thank you for watching this video. Be sure to look for new videos from me soon. If you liked what you saw, be sure to subscribe to this channel and hit the notification bell so that you do not miss out on any new material. Also, please leave a comment down below if there is a topic you would like me to cover. Until next time, have a good day.